Hi, I'm Matt Smith, and this is Spark Spread. Today I had the privilege of speaking to Gary Black. Gary is one of the most influential voices in the Tesla Twitter community. He is a long-term professional investment manager. He's got a storied career on Wall Street with some of the biggest funds, holding CEO and CIO positions there. And Gary's been a long-term Tesla bull. We had a great conversation about his investment approach, why he exited his Tesla position last week, and what he's thinking long-term for the company. So without further ado, here's my conversation with Gary Black. Well, Gary, thank you so much for taking the time for this conversation today.
Thanks, Matt.
Yeah. So good to see you as well. I think a lot of the viewers are kind of familiar with you from your investment in Tesla and a lot of the stock commentary that you put out there on Twitter. But maybe before we kind of get into your latest move with the stock and kind of your overall thesis, could you just give us a bit more background about your professional investing history and kind of where you're coming from there?
Sure. So I started my career as a research analyst back in early 90s at a research shop called Sanford Bernstein. I was covering tobacco, food, beverage stocks. I think the first stock I covered was Philip Morris. Philip Morris was like Apple at the time. Everybody loved the stock. And I put a sell rating on it, which is kind of like saying I'm exiting Tesla. And anyway, I went through a lot of grief for about 7-8 months. Then on April 2nd of 1993, there was Marlboro Friday. And Philip Morris cut the price of Marlboros by, it was like 20%. Stock fell by at least 25. Wow. And of course, at that point, everybody said, okay, that was a good bet. But, that kind of taught me a lot. Sometimes you got to go against the crowd, even when it doesn't feel so good. And believe me, I was not very popular when I had to sell in Philip Morris. People didn't want to talk to me. The companies didn't want me to come to the meetings. But look, sometimes you got to do what's right for clients. Anyway, I rose through Bernstein. I became a principal, then a partner. At some point, I became the head of the institutional business at Bernstein. And then we sold the firm to Alliance Capital. From there, I went to Goldman Sachs. I became the CIO for the global equities business, which is all the fundamental stuff. There was a quant equities business as well, but I was on the fundamental side. I left there in about 2004. I became CIO and president of Janus. And they were interested in me. There was a growth shop. Those of you who've been around for a few years know that Janus was like, that was Cathie Wood at the time. They were the poster child for the dot-com bubble, and it burst and they got killed, and I was brought in to kind of clean it up. So I became the CIO, then I became the CEO in about 2006. 2010 or so, I had a disagreement with the board about strategic direction. Without getting into it, but I left, started my own hedge fund called Black Capital. I did that for a few years, and a fellow by the name of John Calamos, CEO of Calamos Investment. He found me. He wanted to buy my firm. We resisted, but we had about $400 million under management. So it was a good sized hedge fund, but wasn't huge, but it was doing well enough. But he coaxed me to come in and be the CIO. He had gotten rid of his nephew, who was the CIO, bought my firm. And it was a long short fund, and we became part of Calamos. And long story short, after about 3 years, our agreement was up, and we left. So anyway, I went back to being quote unquote semi-retired, and I was coaxed to come into Aegon Asset Management in 2016 to fix, they had some SEC issues on quant models, and I was brought in to fix that business. And then once that was completed, which was about 2019, went back to being quote unquote semi-retired. So I'm managing my own money, running friends and family money. What's interesting to me is the whole world of sustainable investing. We could talk about Tesla in a minute, but look, there's so much momentum toward clean energy and environmentally focused investing. And so one of the things that I and a couple of people are working on is building a sustainable growth fund, which I can't talk about, but I'll talk more about in the next 3 to 6 months. So that's kind of my quick background.
Mm-hmm. So you're working on that kind of the background now, but managing your own money. So all these tweets that we see about the things that you're selling and investing, that's all on your own money.
Yeah, and I'm pretty clear on on the Twitter feed that look, these are my own opinions. Doesn't represent investment advice. But, I know that, some people probably listen to them sometimes, and sometimes they follow. I think it might be helpful just to talk about my investment approach so people can understand, how I got interested in Tesla and
Yeah.
how I exit Tesla. You think that is that worthwhile?
Yeah, I think one of the things that just in hearing your background, I think it's a pretty stark contrast with I think probably most of the people who follow you or are kind of active in the Tesla Twitter community. I think I once called you the adult in the room on in Tesla Twitter, just because I think a lot of folks are kind of more like myself, where they're retail investors that have a high concentration in Tesla, high conviction, long time horizon. But I think with the professional background you come from, I think you maybe just have a different mindset that may kind of inform your recent actions. So yeah, I think it may be helpful to kind of walk through how your portfolio approach kind of plays into what you're
Sure.
doing now.
And look, high conviction is great. That's the people who do the best in this environment are those with high conviction. Look, you don't need advanced degrees. You just need common sense. You need, good
Mm-hmm.
analytical skills are important, and you need discipline, and you need to be, look, you need to have the conviction so that when things go wrong, you stick with the bet and you don't just give it up at the
Mm-hmm.
first sign of trouble. If I had to describe my approach, I call it disciplined growth. I start with, here are 10, 12 mega trends, and I use them as tailwinds. So mega trends would be 24/7 entertainment information, mobility, e-commerce, electronic payments, people living longer, people staying healthy, want to be healthy, automation. I think one of the mega trends we focus on is disinflation. And then, this whole, call it um, sustainability. So clean energy, the environment, that's a mega trend. Once we've identified the mega trends, we start looking for ways to exploit those mega trends. So we look for a few things. So one is uncaptured expectations. So where's our view different from consensus, right? And we can talk about how that applies to Tesla in a minute. We look for acceleration and growth. So one of the things I like is, if the TAM, I use that
Mm-hmm.
term, total addressable market, if that's expanding because of new products, or because of leveraging the brand. So you think about Coke, Diet Coke, or you think about when Porsche was a sports car and then it went into SUVs. That's expanding the TAM, and it's also leveraging the brand. I like to look for asymmetric returns, and that brings in the whole thing about being disciplined about valuation. As Warren Buffett says, rule number one, don't lose money. Rule number two, look back and look back at rule number one. I like to buy really good growth stocks when they're down. Okay, so if something is
Mm-hmm.
off by a lot because of a miss in a quarter, or just something that people don't understand fully, that's when I like to buy it. And so I like to look for very little downside but a lot of upside. So I call that asymmetry. And in the way I like to run money, it's high conviction bets. I don't like to run with more than about 30 or 40 names on the long side. I do like long and short, and my short side is about 30 or 40 names as well. But I want high conviction bets where I can make a big bet and I could stick with it. And I do like to tactical trade. So if I like a company and I think it's a good value long term, I will stick with it. And then if I think they're going to miss a quarter or miss a couple quarters, I might buy puts or sell calls to take the position down,
Mm-hmm.
going into a quarter. But I definitely have a view of high conviction investing. Do your research. Be disciplined about what you're buying, and I like to hold them a long time. I held Tesla from, I'd say, it was about August of 19 until I just got out a couple of weeks ago. I think sell discipline is really important. For an investment manager, you got to have an investment thesis. You got to be able to articulate in about a sentence why you own something, and it can't just be because it's going up. There has to be
Mm-hmm.
a reason why you own it, and we can talk about how I got into Tesla in a minute. But I think sell discipline is important. And again, as we talk about why I exited Tesla, usually it's when your investment thesis changes. So the investment thesis you got in, it's no longer true. Second, your price targets have been hit. If you have a price target on something, sometimes there's price target creep where you blow through it and you raise it because you want to
Mm-hmm.
keep it. I try not to do that. I try to kind of keep my price targets, and then if it reaches it, get out. Although I have rose my price target on Tesla
Yeah,
as I got the data.
I was going to say I think the critics might say, oh yeah,
Right,
every time
right,
they blew through a
right.
target, you raised it. But you
There's
look at
always
the
before.
assumptions.
There's always before. And look, if you're raising your target after the fact, the way a lot of Wall Street analysts do, that's cheating. But I think when you get new information,
Yeah.
new information could be, their market share went up, or the new product they launched, like the Model Y, is doing better than you think. As long as it's based on fundamentals and based on some analysis, I don't think there's anything wrong with raising the price. That means,
Yeah.
especially if the company's doing better than you thought, you should be raising the price
Yeah.
target. But investment thesis changes, price targets hit. This is the one where I think people have issues. If there's near-term upside downside, is not as favorable as it used to be because you think they might miss a quarter or two. I've tended to either get out or reduce my position. And then the fourth thing is if there are better opportunities, and this is where, some people have criticized me and say, well, you're gonna have to pay 20% capital gains taxes. And I look at it as yes, but now I have the capital. And if I have other
Right.
ideas, and I think there's a lot of good ideas out there right now, I can put the money at work and, make whatever, 20, 40% returns. So it's not like the money's sitting in cash, right? I'm
Yeah,
redeploying.
you're if you're redeploying that into something else, then you're establishing a new kind of higher cost basis going forward. So I've never really understood the long-term capital gains as a criticism for redeploying some capital. But
You're going to have to
yeah,
pay taxes on it anyway at some point, unless,
yeah,
pass it along to your kids. But, there is a huge difference. You brought it up, Matt, between a professional money manager and a retail investor. And the professional money manager gets paid on beating his or her benchmark, or usually it's over 1 year and a 3-year period. I was a CIO, so that's how we would judge. I mean, it's usually 50-50 on 1 year performance, 50% on 3 year, and versus your peer group. And so your peer group would be, if you're a growth manager like myself, you'd be compared against other growth managers. And even the benchmark for most growth managers, like if you're Bailey Gifford, you're being compared versus some sort of growth benchmark, not just the S&P. And right now it doesn't matter; they're about the same. But
hmm
you got to beat your peer group, you got to beat your benchmark, and so you can't put the money in cash. You always have to have your cash invested in something. So I think that's one of the big differences. And you own 40 or 50 names; you don't just own one name.
yeah. And so are you? Obviously you're kind of managing your own money now, so you don't necessarily have the strict rules, but it sounds like you're kind of following the same practices generally. Are
Kind
you
of.
are you kind of allocating the way you typically would have between those different names? Are you kind of roughly a similar percentage in each, or are you weighting them differently?
I think I take a lot more bets on my own money,
hmm
which is, sad to say, but if I believe in a name, I've had Tesla up to, 15 to 20% of my portfolio
hmm
at times. And, now it's zero, but I've had it up there pretty high, especially when it gets hit, and there's been so many times, as
Yeah.
where the stock gets hit for some dumb reason, Tesla Q out there trying to, throw FUD at things. There's always a chance to buy it cheaper, and I like to buy on a dip.
Yep.
Um, but maybe we could just talk about why I got involved in Tesla, because that's an interesting story in itself. I think I was actually short Tesla through most of 2019. And because they were missing estimates, they had a ton of debt. There
hmm
was all this talk they weren't going to make it. And I remember early 19. I don't remember what quarter it was. They missed by a lot. The stock went down, and
Yeah, I
there was
think
a lot of talk.
Q1 was a
That
disaster
was a
for them.
disaster.
Yeah.
And that's when and I stayed shorted. And I remember closing it in the summer. And I'll tell you why I closed it. I went and took a test drive in a Tesla. I figured that would be a good idea. And now I tried the shorts. I say, you've never driven a Tesla and you're short the stock? Well, I went and drove an X, and I was like in love with it. The doors, the acceleration. I'd never driven anything like a Model X, any kind of car. And I had a Porsche. I was a Porsche guy. I had a Porsche Cayenne at the time, and I just thought this is great. And at the time, there's a lot of talk about climate change and clean energy, and you could see that as a mega trend that was emerging. I have kids that are in the 20s, and they're conservative, but they're very pro climate change,
Yeah.
meaning they think we should do something about it. And I remember I had a discussion with my son about it. Again, he's conservative like me, but he said, look, you don't get it, that this is something is going to be a huge trend, and people like me are very focused on it. So I did that. And then what happened then? I built a model. I said, I started looking at numbers. And I said, okay, the EV penetration around the world is only about 2%. And,
hmm
I started to think this thing could go to 20-25%. If, again, just do the math, you got to make an
Yeah.
assumption about how quickly that could happen. But if you go from even 3, which is where it was in now, to 25, that's about, that's about 50% growth compounded. And so I did that, and then I started thinking about it. And at the time, remember, you had the Model 3 out. The Model Y had been announced, I think,
Yeah.
in the spring. Cybertruck had been teased a few times. I don't know if it had a name yet, but I remember there was a couple teaser ads on it. And I kept thinking if there could be TAM expansion, because at the time he just had, Elon had the X, he had the S, the 3. If you could bring out a CUV, a crossover, which was about 40% of the market, and a pickup truck, all of a sudden Tesla TAM could go from, it was about 25 to, the CUV segment's about 40% of the market, the pickup truck's another 20. Yeah. And then what's left is really the subcompact, which is, the M2, but that wasn't being talked about at the time. And all I kept thinking is, wow, if they could just hold their share, the EV adoption goes from 3 to 25. If they could just hold their share because they're expanding their TAM. And remember, they were going into China, which was, they'd always exported into China, but now they're going to build in China. I just felt that they could easily hold their share. They could grow their volumes at 50% a year. And nobody on the sell side was thinking that. Yeah. So I built the model, and then, just didn't invest much. I think it was about August 19th. I think the stock was under, it was about 200, 250 pre-split. So let's call it $40 to $50. And then it just started beating. And I remember it was third quarter of 19, Tesla beat, and the stock went up literally, like, it was the first time it beat for a long time.
When they beat by a mile too. I mean,
right, the stock went up like 30%. And I said, okay, well, this is, now it's getting interesting. And of course, when you have huge short interest and you beat, then you get this double leverage, right? Because it beats, and people take the estimates up, the shorts all scramble to buy in. And I owned a small position. And I took my position up, and then, the rest is history. We had, 4 or 5 quarters in a row of Tesla beating, TAM's expanding. The execution got much better. They started doing things on time and getting stuff out on time. Cybertruck came out, Shanghai got up and running. And meanwhile, EV adoption kept growing, and the Tesla share, and that's, there's a debate about this, but the way I model, I start with global SAR, SAAR, the selling rate, as they call it, times EV adoption times EV share. And that gives you volume. So that's the way I model, and that's the way most of the buy side models. And that's why I do it the way I do it. And I know some people criticize that, but that's kind of how I do it. So if I could see EV adoption growing every year, and I could see Tesla holding its share, which is really what iPhone did when it went into the smartphone category, you can get, 40, 50% volume growth. You leverage your operating costs, you leverage your fixed costs, you can get much higher earnings growth.
Yeah. So it's, back in, right around the time when you invested, I mean, I remember that was right around the time when I kind of became highly convicted as well. But I was probably doing it more of a bottoms up approach versus your top down approach. But one of the things that gave me so much confidence at the time was, just comparing kind of my estimates with what the street was putting out there, and wondering if you had this same sort of experience of kind of doing your model, from a top down approach and kind of looking out at, the 2020 earnings forecast, and did you see kind of a disconnect there with what you thought would happen and what the street was saying?
Very similar. So if I'm, again, just to complete the thought, I build a model, I come up with a value based on, I use 2025 earnings, but you could use whatever one you want, discount it back at some cost of equity and come up with a value. But then you got to ask yourself, okay, what's going to happen in the near term? And so like yourself, I would be forecasting the next year's earnings, and I'd be getting numbers that were, 40, 50% higher than where the street was. And I talk to a lot of the analysts. I mean, because I used to be a research analyst, I can call any of them up and they'll usually talk to me. What I found is they just, one, they'd never driven a Tesla, a lot of them. Although Tony Sakinaki, who I talk frequently, he's a bear, he's a perma bear at Bernstein. He actually has 2 of them. Most of them don't accept this basic premise that when competition comes in, competition is going to hurt Tesla badly and their EV share is going to drop. And that, you see that on Tesla Q. Mm-hmm. But when you talk to the sell-side analysts, that is a lot of what the analysts will say. And what I kept finding is that every time the competitors would launch a new EV product, they wouldn't get anywhere. Mm-hmm. And so you really have to go out and you have to talk to Tesla owners. And, this is where Consumer Reports ratings become important. Mm-hmm. People love their Teslas, and, there's all kinds of studies that say, well, there's a lot of defects, but that's not how consumers think. They don't think about, the door doesn't, has a paint chip, missing or something.
Yeah,
They think about, does it work? Is it a good car? Am I satisfied? Great acceleration, the technology. And so there's so much strong word of mouth with Tesla
mm-hmm.
you got over a million, 2 million, 3 brand ambassadors talking about their Teslas. People love their Teslas, and I can understand it. So, yeah, I saw a lot of my estimates were so much higher than the streets, and and that to me would say, okay, you get to the quarter, if they could beat the volumes, they could beat the earnings. That's fuel for the stock because you're going to have more and more positive revisions. And then second, the shorts have to close their positions. And then third, everybody on the sell side, there's 2/3 of them had holds or sells on the stock. So you've got a lot of upside potential for
mm-hmm.
people to go positive. So as you ended 2020, it was obviously a great year for everybody. It was up 740%. I'm looking at the stock and I'm saying, okay, we've had a nice run. And you still have a lot of catalysts in 2021. You've got, Biden will update, the EV credit, restore it, if you will, because there's a cap. Both GM and Tesla are through the cap. When Berlin opens, you can actually get the pricing in Europe closer because you save on the 10% import tax and the shipping cost. You got Cybertruck coming out. You got Semi coming out. The M2, which will be a hatchback, which will be made out of Berlin, out of Berlin, that will probably be announced in early 22 from what I hear. And then the balance sheet continues to get better. It could almost be investment grade today. And I look at all those catalysts. I say, look, there's a lot of catalysts that can drive the stock. And so, look, from a long-term perspective, it's a great value. If you're a retail investor and it's the only stock, you should not sell it. You should not do what I do. You should just hold on to it, ride it, and it'll be fine because within, 6-9 months, it'll probably be back to where it was when I sold it.
So, yeah, so I think you went over the selling part pretty quickly. So I want to maybe try to unpack some of the details. So you sold, was it last Monday, I think, when the 10K came out?
Yep. So let me talk about that. So, and it's a fair question, and I've received a lot of grief,
but, which you're not unfamiliar with, given your Philip Morris history, right?
I have a thick skin. So there's a few reasons I would say. One is, again, upside downside. When the stock is at 800, you can't like it as much as you liked it at 400 or 200. You don't have as much upside. It can't be some people say it's going to have the biggest market cap of any company, but it can't. It can't, keep going at the same rate. So upside downside, while it's high, if it goes from 800 to 960, that's still 20%, right? But I was looking at the downside, and so here's my red flags. And this, you got to put my analyst hat on your head. Okay, so first thing is, and I've gotten a lot of grief, including from you, Matt, about this. They missed the fourth quarter volume number by 350 cars. And as an analyst, again, if you're not if you have excess demand and you're building cars, why couldn't they get those 353 cars out to get above the number? I don't know. Maybe they just lost track. In the 5 or 6 quarters I owned the stock, they never missed, right? So that was that wasn't a red flag. That was kind of like a warning sign. Like, this is interesting.
On that one, so I was a little bit surprised by that too, to be honest with you. I mean, I was thinking they might, beat by 2,000-3,000 cars, something like that. But at the same time, nobody would have, expected the plant to be shut down for a month and a half. Fremont to be shut down for a month and a half.
No, but that was back in March. I'm just looking at fourth quarter versus fourth quarter.
Sure, okay, but but the 500,000 was full year, which was guidance that was given pre-COVID.
Right, and but that's not really that relevant. What's relevant was the fourth quarter, which the 500 was reiterated at the end of third quarter.
Yeah, okay, I see. Yeah,
you had a volume target of let's call it 180,000, and they missed it by 350. And look, that wouldn't be a reason I would get out of stock. To me, that's minor, but it's like that's something to think about.
Yep.
Second thing, which is more important, which is an issue, is they missed the earnings number by a lot. They came in at 80 cents, adjusted earnings, we use non-GAAP. And the street was at about $1.03, $1.04. I think you and I were both probably $1.05 to $1.10. Some other people were higher. Yeah. But they missed by a lot. And it was gross margin. And, what kind of got my attention was on the conference call, they talked a lot about these are one-time factors. They talked about, the SX refresh. They talked about, the COVID disruption, the semiconductor short. They talked a little bit about, the pricing, and said these are one-time factors. But when you start thinking about, a lot of these are not one-time factors. The SX refresh is continuing into the first quarter, and it's slow. And you can see that because you don't see a lot of volume, and it's going to come back and hurt the volume numbers in the first quarter. I don't know by how much,
Yeah.
but if they normally deliver 11 or 12,000 SXs in the first quarter, it's not going to be anywhere near that, right?
Mm-hmm.
And so that's going to hurt gross margin in terms of absorption, cost absorption. The Made in China Y is essentially a new car. And when I've talked to the company, I do talk to the company enough, not a lot, but enough. They will say that it is essentially a new car. The SX refresh is a new car, so it's not as easy as just refreshing and getting it out there. And the Made in China Y is also a little bit slow. Okay, COVID is still disrupting things. The semiconductor shortage is still out there, and the pricing in Europe is still high. Okay, so I'm looking at this saying first quarter is still going to be light, and so. When I try to figure out, is a company going to miss a quarter, you got to look at two things. You got to look at the street estimates, and then you got to look at what the buy side is looking at. Kathy Wood, Ron Barron, others, and you can't always get that. There's services out there you can pay for, but you can look at Twitter, and you can see what types of volumes people have. And look, Twitter is probably better than most of the estimates out there. And so as I think about, let's just take first quarter and second quarter. I try to model out the quarters. I'm getting about 162, 165 for the first quarter. The street's at 167, but a lot of the Twitter analysts are up at the 180 range. And, there's a bunch of them out there, but I'd say on average about 180. And in the second quarter, same thing. I'm about 10, 15,000 less than where everybody else is. So when I put it together, first half, I'm at 345, 350 in volume. The street's at about 395. Okay, so it'll come down. The street's pretty high for second quarter. And on earnings, I'm also about probably 10 to 12% below the street for the first half. And then again, we'll call them the Twitter community analysts who actually do this stuff, and they do a good job. They're higher. And look, I would expect the Twitter analysts will come down because, I do think the SX refresh is taking longer. The Made in China Y is taking longer. The pricing in Europe, as we talked about, is still high. So I just think then you got to decide, do you want to get out of the stock because of that? Enter Bitcoin. Okay, so I'm annoyed. I'm not annoyed by it. I mean, if they want to own Bitcoin, they can own Bitcoin. But again, as a professional investor, it does introduce huge earnings variability. And what people need to know about Bitcoin, and we can talk about Bitcoin as an investment if you want, but what people got to know is, the professional investor is going to be annoyed by them using 8% of their corporate cash to buy Bitcoin, because the gains you can't recognize unless you sell it, but the losses you have to, basically put an impairment charge in if it goes below what you paid for it. And what most people do, and you can look at MicroStrategy, I was looking at that today. MicroStrategy, they have to show it as they can show their losses, but there's no gains because they haven't sold anything yet. Mm-hmm. So they back out the losses to come up with a non-GAAP earnings number.
Yeah, well, that's what I was going to say just now. Actually, I mean, wouldn't all the analysts just kind of back out, whether it was a gain or a loss, whether they sold the Bitcoin and backed it out? Is the earnings variability the primary reason that you don't like it, or are there kind of other concerns? Is it, I don't know, a lack of discipline, or just trying something unconventional? Are there multiple different facets to your kind of discomfort with this action?
Look, maybe it's my generation, okay? And it's possible. And people said that, well, you're a boomer.
Well, hey, you're on the environmental side, which is that's something to be said.
But I think a lot of the professional money managers out there, they're boomers, okay? And so, and let's not, mention names, but I do think when you have all these put together, you've got really light, not really, but light first half volumes. You have an earnings miss from fourth quarter. Forget that they missed the volumes, but you have an earnings miss. As you look forward, the volumes look like they're going to be light, and you throw earnings variability on top of that. You take somebody like Baillie Gifford. Baillie Gifford is I think they're the second largest active manager who owned Tesla after capital. And I exclude Vanguard and because they're index shops, they have to own it. But the guys who actually make a bet, the girls make a bet. Capital's number one and Bailey's number two. And Bailey Gifford, if you look at I look at their fact sheets every month to see what they've done, because they don't have to report except for once a quarter. But you can get online and you can look at their fact sheets. You can see that they've reduced from December to January. They've gone from 8.9 to 5.1 in their flagship Scottish mortgage trust. Who knows why? Okay, but you take those three things together. You take that they missed in the fourth quarter, which again, as an analyst, usually you give companies more than a quarter if you're going to sell off. The first and second quarter volumes look light relative to the estimates I'm coming up with. And then you throw Bitcoin on top of it, which Bitcoin could be up a lot or down. And you're right, people are going to back it out. But it is in earnings. It does create a lot more earnings variability. And look, I don't know what you feel about this, but when Elon, who he's brilliant, he's the most successful entrepreneur of my generation, your generation. But every night he's talking about Dogecoin, he's talking about Bitcoin. And I'm sure that's not his focus, but he should be talking about Cybertruck, and he should be talking about other things that are coming out from Tesla, and he's allowed to. There's a quiet period that occurs from about the last week of the quarter until usually like a week after earnings come out, where they really can't talk about it. But he could be talking about anything he wants today. And what I say to people is, look, if Elon likes Bitcoin, he could buy it himself, which is what a lot of other CEOs have done. So I can't say I sold because of Bitcoin. It's you add all those things together, and I just say, enough. It's been a good run. Let's step back. I have a 960 price target, which I think is my value. I think it's worth. I think, where would I get back in? It's not a number. It's more of a, when do the first half estimates get real? And when do I think, that's in the stock? I don't know. I don't think we're there yet. Let's put it that way.
Yeah. So one of the things, a practice you've had on Twitter for a long time now is you'll post catalysts on a regular basis, and you're always kind of, adjusting those based on new information. It sounds like what you did after Q4 came out is, you're kind of going through, kind of anticipating maybe some of these negative catalysts, and decided to sell, which, based on the timing, what would you sell? 873, is that right?
Yeah.
So,
that's the number.
It sucks. I couldn't remember if it was 883 or 873. So,
873.
From where we are now, the stock's down about $90 from there. So, as of right now, it looks like a good move. If you were to re-enter today. So, I'm curious, as you've seen maybe some of these negative catalysts that I think you were anticipating kind of come to pass. We got down to 762, I think it was yesterday or the day before. Yeah. So I guess do you still see there's some of these catalysts need time to play out? I think, we haven't seen a whole lot of analyst kind of revisions on volumes or earnings for 21 come out yet. I do think you're right, by the way. Some of the stuff does need to be revised down. I mean, I'm looking at my own numbers and revising a lot of stuff down just based on the latest information. And I think that's a good practice. I think it doesn't help us at all, in the Tesla bull community, just to only be kind of thinking about the positive things. I think it is wise to be taking into account the negative things as well. But it sounds like it's maybe a number partially, but you really want to just wait and see how some of these negative catalysts kind of play out. And you would expect if they do play out the way that you're thinking, then you'd be in better position to kind of redeploy your capital back into Tesla. Is that fair, regardless of where the price is at that point?
I think it's fair, Matt. I'm looking for asymmetry. I'm looking for, again, don't lose money. Something where the downside is limited and all the bad news is in the stock. Okay. So what's the bad news? The bad news can be that volumes in the first and second quarter, I think, are going to be lower than where the street is and lower than where a lot of the Twitter community sees them. The pricing in Europe is still very high. And it's because, again, you got that 10% import tax and you got to pay for shipping. Now, in the short term, they're fixing that because they're now selling made in China Model 3s into Europe. And and you saw that in Japan last night. They cut the price by, it was 25% on the base model. It was 17 on the base model, 25 on the long range. They could do the same thing because it's so much cheaper to make and ship from China to Europe than from Fremont. I'm surprised we didn't see a price cut in Europe, because now, they're shipping from both, right? There's some stuff coming in from Fremont. Mm-hmm. There's also stuff coming in from Shanghai. So it wouldn't surprise me to see some price reductions in the first quarter in Europe. I'm just surprised we didn't see them last night when they announced the Japan price cuts, which is interesting. So I need to see the estimates get real. I think the whole EV question is up in the air. My sources in Washington say that, Biden will talk. Remember, Biden has 4 huge initiatives that he announced on Inauguration Day. And, it's COVID, it's the economy, it's racial inequality, and it's clean energy. He's got this speech. We don't know when it's going to be. It was supposed to be next Tuesday, the 23rd, but it's not a State of the Union address because he's a new president. It's called a Joint Sessions of Congress, but it's like a State of the Union address. And he will have an hour, maybe an hour and a half, to talk to Congress. And my bet is he will, at that point, talk about it. It's supposed to be part of his infrastructure bill, but they don't even have the COVID relief bill passed yet, so everything's getting pushed back. I don't know why, but you would think with, Senate and the House, both in Democratic control, they'll be able to push it back. But anyway, I think they'll announce it. And then the question is going to then be, will that cause buyers to wait and say, well, I'm not going to, they'll walk into a Tesla dealership and say, hey, I want that EV credit. And they'll say, well, it's not been passed yet. And who knows? By the end of the year, they'll get it. So from a full year standpoint, it's fine, but it could cause first and second quarter volumes to be, delayed a little bit further on top of everything else we have. If they could get the made in China Y up quicker, I think that would be good. And if they could get the S and X out quicker, that would be good. And if you already had lower pricing in Europe, I think that would be good, but we don't. So I still think the first and quarter volumes have to come down. So back to your question, I think I need to see the estimates come down, and I do think the price is going to come down a little bit more. I've said mid 7s. Well, mid 7s could be 720 to 780. It could be anything.
Oh yeah, when we dipped down to 762 for like a minute, I saw they came out of the woodwork and say, "Oh, you must have rebought already."
Look, I like Tesla, and just you can see what I tweet. I try to be balanced. I've always tried to be balanced, even when. I remember back in Battery Day, I told people there's nothing new here, even though a lot of people said, come on, there's so much new. You don't understand it, blah, blah, blah. But, relative to the expectations, which is what I'm always thinking, I just thought the stock would give up some. Same thing with the S&P inclusion. I was not negative, but, I got a lot of grief for saying 650 to 690 when everybody was saying 1,000. And then on top of that, said, well, it's going to retreat 10 to 20%, which, it did.
Yeah, you called both of those like to a T, by the way. And I was one of the ones, I wasn't, maybe super bullish saying we're going to be 1,500, but I at least thought there was a chance you could have, maybe a more pronounced squeeze. So I think, you have been very accurate with the, kind of a lot of the tempered expectations that you've set, over the last year or so. So, I do think it's wise for, people to be listening to what you have to say. Disagree if people think about it and have a different take than you, but I think it absolutely is a good idea to try to check your thesis and kind of go back and recheck your assumptions from time to time. So I do appreciate you being balanced on that front.
I've always been trying to get both sides, but I think people are just, I don't know, they're just they almost like they take it. There's like a breakup almost, people do it. But look, as a sell side analyst, I go back to that. And even as a portfolio manager, when I was portfolio manager, you'd want to hear the bull case and you'd want to hear the bear case, right? And I think, look, as a retail investor, the last thing you want is an echo chamber where people are only saying the bull stuff, and you know that. But
that's Tesla Q. We've seen how that works.
Right. You don't want everybody always talking the bull case, and I think where people are, I don't know if they're miffed about the Bitcoin part of it or what, but I think people they question my motives and say, well, you're just trying to push the stock up. Thank you for the compliment, but this is the most actively traded stock in America. I am not going to push the stock price down. It's just stupid. I can't. It's absurd. So what I'm trying to do is give people, value-added insight. I've been very transparent. I don't own the stock. Again, thank you for the compliment, but I can't push the stock price around. Yeah. I'm not able to.
So I want to go back to one of the things on the Q4 call that I think you criticized the Tesla team for. and that was the 2021 guidance. So, I think a lot of analysts had been expecting a number, on the Q3 call after Pierre Ferragu's question. There was,
Yeah,
Elon kind of
840 to a
jumped
million.
in. Exactly. And, so I think there was reasonable expectation maybe for, a hard number. What they did instead was, reiterated long-term guidance of 50% growth, which, just taking a step back, that really is absurd to kind of give
Big number.
long-term 50% growth. But I think you were in saying that in 2021 they may materially exceed 50%. So why was that so problematic for you? Because I
Yeah.
know that was something that you kind of pushed back on, is saying that was
Yeah.
insufficient guidance.
Look, if I was following a company as a sell side analyst and all of a sudden people withdrew short term guidance, and not because of COVID, right? A lot of companies withdrew guidance, when COVID came because you couldn't
Mm-hmm.
predict. But if a company has always given at the beginning of the year guidance, and then suddenly it says, well, we're withdrawing guidance, so we're not going to give guidance this year. That is a red flag usually. And I think in hindsight, because I have Twitter as a stock too, and I like Twitter a lot. They had a very similar situation. Their first and second quarter DAUs were going to be light. In fact, second quarter they're actually predicting low double digit, low double digit rate, and they were very specific. They said, here's what the numbers going to be first quarter. This is going to be the numbers second quarter. And they, is a very similar situation. It was less than what the street was expecting. And initially the stock fell off, but within a few hours, it just took off. And now it's at an all-time
Mm-hmm.
high. And I've discussed this with Tesla. I said, look, a better way to handle this is just, give people the bad news. Say, here's what we're going to do in the first half. And they'll never admit, they'll never say you're right, Garrett. They'll never say your numbers are right. They just listen. But the bottom line is, I don't think the way they handled it was correct. I think if they thought that the first half, if they thought the first half was going to be light, they should just say it, and people will buy the stock once the bad news is in the stock. And I think by getting called wimpy about it and saying, well, we're not going to commit to anything, but it very may well be above 50% or well in excess of 50%. You have to kind of read the words that Elon said versus what Zach said. It just was a red flag to me. And maybe, look, maybe I'm reading into it too much, but I do think the first half, again, putting all this stuff together, including my own analysis, is going to be light. And I think that's why they didn't necessarily want to commit.
Yeah.
Who knows? That was where I came from.
Yeah, so I maybe read it a little bit differently. I mean, they were talking at that part of the call about kind of the uncertainty of ramping, Austin and Berlin.
Right.
So they're basically saying they're pretty comfortable with 750, but just not quite sure how that very first stages of the S curve will ramp. So, but if I'm hearing you, I mean, it sounds like none of these factors were kind of one massive red flag that kind of caused your core thesis to crumble. It was more a couple series of short-term issues. It sounds like. I mean, that kind of pushed you to reevaluate your whole position relative to other options that you had in the market. And that was, another thing you mentioned earlier is, the reasons that a portfolio manager would sell. And so maybe could you talk about that part of it a little bit? What were you trying to redeploy into that looked a little bit more attractive?
Well, look, research is a mosaic, right? It's a lot of different pieces, and it's not one piece. I wouldn't
Mm-hmm.
exit something I love like Tesla because they missed by 350 cars, or the guidance was wishy-washy. And to your point, the street I think is at 815 or so for 2021 in terms of volumes. That's the estimate. So if they just do 750, and that's kind of how you have to interpret it, it's at least 50%. That's light versus the street. Now, if you're Apple or Google or Facebook and you're trading at 30 to 35 times earnings, nobody's going to care. But you're Tesla and you're trading at 200 times earnings, and you're telling people, well, instead of, even though the street's at whatever 815 is, let's call it 63%, we're going to do 50 and maybe more than 50. There's a good chance we'll do more than 50. But again, you have Elon saying, I'm not committing to this, but it could be more than 50. That's a miss the way a professional investor reads it. Okay. And again, when a company has always given in that fourth quarter
Mm-hmm.
what the next year's guidance is, and then this year they decided not to do it. And you're right. There's good reason. Um, Berlin is getting pushed back for whatever reason. Maybe Austin's going to take longer to get up and running. Who knows? But to me, it was a red flag, and to me, it said, you know what? It's had a good run. Just pause. It's not like I would short the stock. I wouldn't. I would never short Tesla in a million years. And as I look out, so I go out and I try to do my 5-year forecast. I've got somewhere between 780 and 800 for this year. I'm kind of redoing my numbers. So that's 60% growth. I've got even more growth for next year because you got Cybertruck coming on, and look, we've got 750,000 orders, and a lot of those are going to turn into volumes. Now they're only going to be able to probably make 250 a year, but that's a big increment to next year.
Mm-hmm.
And then you got the M2, and the M2, I believe, I think what they're going to do with the M3 is they're not going to refresh it. And I think Troy Tesla has said the same thing. I think from different sources. But rather than refresh it and rather than cut price, they'll use the made in China M3 to get the price down, and then go right to an M2 hatchback at 25,000 euros. And so they'll have the Model Y, which will be produced in Berlin. They'll have the M2 hatchback, and they can have 60-70% volume growth next year too.
Yeah.
But again, you don't know what happens after that. But TAM at that point, you're in China, you're in Europe, you're in obviously in the US. You're up to 70-80% once the pickup truck and once the M2 comes out. I don't think the M2 will ever come here. I don't know, maybe it will. We're not hatchback as much as Europe is. So at that point, I actually think volumes are going to slow. They're not going to be 50% after about 2024, unless there's something new that's coming. And that's where you get into things like FSD, level 4, level 5 automation, where you can have robotaxi, and that's a whole different analysis. So back to your question, that was my thinking with fourth quarter and the guidance. And it wasn't so much that I was annoyed that they didn't give guidance, because I don't need to be spoon fed, but it was just it was different than what they've done in the past.
Yeah. So, I think there's a tendency among a lot of the Tesla Twitter analysts out there to kind of say they're production constrained always, and kind of look at it from a bottoms up approach. So they'll say, oh, look, in the latest investment letter, we can see we've already got a million units of capacity already online, plus they're building 2 new plants, expanding capacity on top of that. So Tesla's just completely sandbagging, and they'll do 1.1 million. I've seen that argument a lot.
2021.
Yeah. Yeah, I've seen it. You're obviously, everything you're saying today is kind of, you're way more focused on a top-down approach, looking at TAM, looking at what the market share is versus kind of the capacity view. So yeah, I just wonder, do you look at the capacity, or kind of the how do you kind of check your market share assumptions against the planned capacity? How do you think about those? Because there are different ways of looking at it.
Sure. And first, look, I'm not so top down. I actually have a model that looks at by country, by model. So I have a forecast for Model 3, Model S, Model X, Model Y. I have a Cybertruck model. I have a semi model, although it's not that big. And I have M2, and I have it North America, so it's US and Canada, EU, and then China, and then the rest of the world. So it's four markets, and so it is bottom up. I guess, look, I grew up as an analyst.
Yeah.
And what management says is not always right. Okay. And I go back to 2019, there was a lot of misses. There was a lot of guidance, and the company missed a lot. And at the end of the day, I have to do my own work. And so, you want to take the guidance as being, what management thinks. And the production is definitely what management thinks, but that's not the demand. And I don't want to say that, there's the demand problem. People have misconstrued some of my comments. I don't think there's a demand problem. But I think, in 2021, I can't see them doing more than about, 800 is kind of my top number. And, it's somewhere between 760 and 800, still 60% growth. Yeah. But again, the street's at 815. I would wager, a lot of money, they're not going to hit 1 million deliveries for this year, just because they think they can produce 1 million maybe. because at the end of the day, you still have these issues in the first half. And so
Yeah.
it's hard, it's hard if I'm only getting, let's call it 350 in the first and second quarter, that would mean 650 to get to $1 million. Now, if they do $1 million, somebody asked me this the other day, what would be your price target? Just assume they hit $1 million for this year. And yeah, my price target would probably be 1,500 if I was 100% convinced they could do it, but I don't think they're going to get that high.
Yeah. So, I think one of the things I've picked up on through this conversation is that, you're very focused on the core automotive, opportunity. You were just talking about full self-driving and kind of the L4, L5, autonomy option. I've always viewed that as kind of a call option, for the stock. Do you kind of buy into that mindset that it either happens or it doesn't, and if it does, it's a massive catalyst?
Yeah. Well, look, there's a couple things that you can add to it, add to the valuation, but you could add solar, but they don't make money on solar, and it's very small.
I was going to ask you about that next,
actually.
So I'm kind of curious.
They still don't make money on it, but they will. But it's rounding error, right? The money is in the automotive business, but robotaxi is a big factor, and you either add value for that or not. So in my model, I add the, right now they're charging $10,000 for FSD. The take rate has really dropped. It's down to mid-teens, and largely because China as a percentage of the volume is so big, but the take rate in China, as you know, is like 3.
Yeah.
So the percentage overall take rate is very low, and in Europe is, I think it's like about 10. And so the $10,000 number is a big number. So of course we're going to have, I call MRR, monthly recurring revenue model. They probably have another name for it. That'll be launched soon. And again, I look at it as you're probably going to have some sort of a teaser rate, like $99, at least initially, and it'll probably go up. And that'll get the take rate up a lot more. Okay. Mm-hmm. So I build that into my model. So when I try to forecast earnings for 2021, 2, 3, 4, 5, I assume a take rate, as you do, I think.
Yep.
And then I try to assume, what that translates to at the bottom. It all drops to the bottom line. So you can do it that way, or you can take that out of your model and you can say, okay, what is FSD worth? And if you could charge some sort of revenue and Tesla gets a cut of it, there's a value to that as well. You can do that, but you can't do both, right? Mm-hmm. Unless they're going to get into a whole new business. They're going to compete with Uber and Lyft, and they're going to have, a business where it's the Tesla network and it's totally independent of that. Okay. So they have their own cars, and you can't count both. You can't count it in your model and then also count it separately. You're selling the cars. Now, if you think you're going to have incremental cars because you have a robo-taxi network, that's fine. Okay. Yeah. Then you can add it. But then you got to ask yourself, okay, you've got a lot of people who are trying to come up with this self-driving car, let's call it L4 autonomy at a minimum. I'm not smart enough to know if Tesla's going to get there first, or Uber's going to get there first, or Amazon's going to get there first, or Baidu's going to get there first. I don't know, but let's assume Tesla gets there first, okay? And I can guarantee you Tesla knows how to scale it, whereas these other guys, they might be able to get there at the same time, but it's going to cost an astronomical amount because they can't scale it. I just don't know if you can put, at this point in 2020, what this is going to be worth when it gets there, when you got everybody trying to get to that holy grail.
Yeah.
So I'm sticking with the way I model it, which is, it's an add-on. It's like you say, it's a call option. It's an add-on to the base revenue. I think the take rate's going to go up once the MRR, offering is made. But I don't want to count it both ways in two value streams.
It's interesting because I actually do count it both ways, and I've thought a lot about this, and I have a good case to believe that it's right. Yeah. So I think, even in a robo-taxi future, my mind, and I've run a lot of economics trying to, look at it from a fleet owner's perspective to make sure it makes sense. Look at it from Tesla's perspective to make sure it makes sense. And I think the way that it would have to work is that, they would charge some sort of price for the actual software when you at purchase or roll it into a subscription. Then I think there also would be a platform fee, which is what they talked about at Autonomy Day. So, in the modeling that I'm doing, the longer term modeling, I do look at the, just the the increasing take rate once you add in, the subscriptions and, the software just improves. So it's almost more like a convenience feature. So I kind of value that, and then, value a much higher full self-driving price, with platform fees separately, and kind of that's the call option piece. So
let me ask you. So you're, again, in your model, not to get too
yeah,
detailed.
sorry, we're gonna lose half the audience now. Go with
I'll ask a simple sentence. So are you adding extra for Tesla as a revenue stream that they're getting from the network? So
yeah.
if you're lending your car out, if you will. So all I'm asking is, do you add it incrementally as a revenue stream for Tesla, that if you're using your car as part of the network, you're collecting some revenue from it, Tesla is getting a piece of that, and that's the incremental revenue stream.
Right.
That,
yeah.
okay.
Yep.
That's fair. That's fair.
That and a higher upfront price as well. But that's not the base case assumption. That's a separate valuation from kind of the core automotive business.
But don't you think Uber and Lyft and forget the other guys? I mean, don't you think they're working on that too, because they want to, eliminate the driver so they don't have to pay the driver?
Yeah, it's certainly their biggest cost. I think absolutely. They're certainly working on it. I think the question, as you alluded to, is who can scale, economically. And I don't know how you compete with Tesla's costs when they're getting their customers to pay for the development of all this technology. They've got by far the biggest data lead. They've got a low cost approach with just passive camera, passive optical recognition versus the LiDAR is a lot more expensive component. So yeah, who knows? I could be wrong, but I think it is maybe one of the longer term catalyst opportunities out there. And that's I kind of wanted to maybe wind down with your thoughts on the the longer term opportunity. You've highlighted a lot of short term, near term headwinds that I think are fair. I don't completely agree with all of them, but I think they're fair. But has anything changed your core thesis, or are there any of these assumptions that you think maybe drag on beyond 2021? And how are you thinking about the longer term?
No, long term, I think Tesla is a great value. When I go out to 2025, I'm assuming that we're at 25% EV adoption globally. Some countries are higher, but 25% up from 3 is a big increase. Okay.
Mm-hmm.
And I'm assuming that Tesla about holds its EV share from where we are today. I mean, it's probably about 23%, I think, what I have in my model for 2020. And it dropped from first half, it was like 27. And the fourth quarter, and a lot of people made a big deal, it was under 20. And a lot of it is because in the fourth quarter, as you know, a lot of the European manufacturers just dumped all their cars out there. They gave them to their dealers, and
some channel stuffing going on there.
They jammed it all out, and as you know, that nothing's moving in the first quarter. There's just too much inventory out there. But I'm assuming that they hold their share because of increasing TAM over the next couple of years. So as I get to 2025, and again, ignoring the robotaxi, assuming I get 25% EV adoption and roughly 25% EV share times a global SAR of about 80 million, which isn't really that much because it's right now it's about 72. You get when you multiply it out. I have ASP, average selling price, going down because they're launching the M2. Mm-hmm. Cybertruck will bring it up, and obviously Semi will bring it up. And I have auto gross margin getting up ex red credits, and I have no red credits after about 2023. When I put it all together, and I have a healthy increase for SG&A, I'm getting $29 a share in earnings by 2025. And then you have to figure out what multiple will the market put on. Today, the market's putting a multiple on next year's earnings at 200. But as I get out to 2025, and this is where the robotaxi discussion becomes important, the market's going to say, okay, for the growth rate I have from 2025 on, what multiple should it be? And I'm just putting a 2 times peg on it because I'm only coming up with about 25% growth from 2025 on. So I put a 50 multiple on it, and I think that's conservative. Times $29, that's $14.50 discounted back. That's worth about $9.60, and interest rates have gone up, and that's why a lot of growth stocks have gotten, not just Tesla. I mean, a lot of growth stocks have gotten hurt as rates have gone up. So I'm coming up with about $9.60. To me, at 800, or where we finished today, 787, it's a great value.
Hmm.
So I'm not opposed to people just holding on. And look, if I didn't think the way I did, where there's lots of opportunities out there, I probably would have held on to it. But I'm just looking at it and saying, okay, 2025, it's worth a lot of money, probably 1450, discounted back worth 960. It's worth holding on. And I have no issues whatsoever with, it being one of the best plays out there today,
Yeah.
best investments out there today.
Yeah. So I did want to hit on the interest rates too. I mean, that's one thing that with the way that you do your valuation, you're going out to 2025 and discounting back at the cost of equity. So as interest rates have started to creep up a little bit, have you brought down your or have you brought up your cost of equity in your price targets yet?
Yeah, so that's one of the reasons why my price target came down, because I think I was using about 1%. And now, the 10-year, which is the risk-free rate, if you think about a cost of equity, it's a risk-free rate, whatever that is. Right now, it's about 1.25.
Mm-hmm.
Usually, equities outperform 10-year treasuries by about 6%. You go back 50 years, that's what we call an equity risk premium. And then you got to adjust it for the beta, right? Because
Mm-hmm.
if a stock is more risky than, say, Apple, which has a low beta, even Amazon has a low beta, you got to adjust for that. The beta of Tesla, we'll come back to this on Bitcoin in a minute. The beta is about 1.6,
Mm-hmm.
and that's pretty high beta. So you take the 6% times the 1.6, that's kind of what you need for on a risk adjusted basis. Add that to the risk rate. I'm using 10.75% as a discount rate, where I was using 9.6, a while ago.
Okay.
And it doesn't change it that much if you do the math, but it changes it enough that you have to be true to your analysis.
So I think your price target was 1,000 before, and then you brought it down to 960. Is that so? That
Just
was
based on
a
that.
factor. Yeah.
Yeah. And
Okay.
if rates went to 2%, and right now the 10 years at 1.25, and I don't think that's going to happen. I think, there's a little bit of head fake here. Everybody's saying with vaccines, with the economy reopening all
Yeah.
over, inflation is going to rear its ugly head. I disagree with that. You have price transparency, you have automation, you have global sourcing. I think, the secular inflation rate, is going to stay about where it is today. I don't see it zooming up as everybody else does. And this whole reflation trade is causing people to buy, Nordstrom and JetBlue and, all kinds of stuff that are going to benefit from an opening. I'm much more, no, you'll see inflation come back down, and the Amazons and Googles and Facebooks and Twitters and, Teslas of the world will do just fine. But there's a lot of discussion out there, in the industry about maybe you should be lightening up on the secular growers and buying more of the, the value plays.
Yeah.
That's not me.
Yeah. So you did touch on this too, but the Tesla's balance sheet, they're still, in my mind, woefully underrated on their credit ratings. You said they're, pretty near to an investment grade rating in your eyes. What do you think, kind of needs to be done to get them over that hump? And, do you see that kind of compressing beta down to, more a 1 or something closer to what Amazon and Apple have?
When S&P added it to the S&P 500, and you got to think about stock price variability, that's what drives beta. I thought that combined with an investment grade credit rating would really push the beta down.
Mm-hmm.
And so again, one of the problems is now you got the Bitcoin variability, which you're right, from a financial analyst standpoint, they'll back it up. But the credit agencies don't do that. They're going to look
That's
at
a good point.
they're going to look at the variability, and they're going to look at GAAP earnings. They're not going to look at non-GAAP earnings. So, people say, well, what happened to Moody's? Should they have upgraded? But I don't know why they didn't upgrade it. They should have, because the credit rating's gotten so much, or the credit ratios have gotten so much better.
Mm-hmm.
The debt coverage, the interest coverage, debt to capital. They've raised, $10 billion of equity in the last 6 months. You would think that they would just say that the rating's got to go up. And I'm not sure why they haven't. And again, as an analyst, you don't know why somebody doesn't do something.
Yeah.
I think the rating should be close to investment grade, at least one notch below. I think it's just a matter of time. So I think they just got to execute. If they can deliver 750,000 units this year and execute, and gross margin at least, stays equal or gets better, I think they'll be close to investment grade by the end of the year. So, but I can't tell you why Moody's didn't upgrade them. And, at this point, I don't think they're going to upgrade them. They would have done it already.
Yeah, no, I would agree. It doesn't make any sense to me. I mean, their operating cash flow metrics are just, crazy, and their debt level is so low overall. I mean, you compare to the rest of the auto industry, and if you look at a debt to equity using market cap, I mean, that's just crazy how little leverage they are. So to still have their credit ratings doesn't quite make sense to me. But yeah, I think you're right. I think it's just a matter of time.
And look, one of the problems, and again, I don't want it to be an echo chamber. The red credits in the fourth quarter, if you back them out,
Right.
they were, they barely made money. And you could argue they didn't make money, and some people have. I think they need a couple more quarters of showing that they don't need the red credits. So as red credits come down, which they will this year, and they may disappear within a couple of years, I think the credit rating agencies, just like S&P last year, they needed to see that absent red credits, they could make money for a couple quarters. I think the rating agencies who don't look at non-GAAP, they look at GAAP. Okay, they need to see on a GAAP basis that they can make money consistently. And the problem is going to be in the first half if the volumes come in light, that they hopefully they can still make money on a GAAP basis, which I think they can.
Yeah.
Right? But just think about fourth quarter. Fourth quarter, if you back out red credits, put out an after-tax basis, you back it out, it's pretty close to break even. And then first quarter and second quarter volumes will probably be less than fourth quarter, my opinion. And so you may have a couple more quarters where the rating agencies just want to watch it. S&P is already, I think, 2 notches above Moody's. Moody's is like three notches below investment grade. S&P's, I think it's 2 notches ahead of Moody's, but I'm surprised Moody's hasn't moved, because usually Moody's, they follow S&P in lockstep.
Yeah. So, I mean, it does seem you start putting all this together. Certainly a couple concerns you've laid out for first half, but if you start taking it into consideration, some potential upgrades in the second half, a lot stronger deliveries coming on in the second half. I think it'll be an interesting year for sure. I'm not sure how it'll shake out, but I'm excited for the second half in particular. I think it's gonna be real exciting to kind of watch how these plants come online and see what happens as some localized production.
If you can get Biden to propose the EV credit, restoration of it, Congress passes it. Let's assume, like the Republicans can filibuster. It depends what he throws into this infrastructure bill. If there's like a whole bunch of stuff in it, Republicans aren't going to go for it. But if he keeps the infrastructure bill kind of clean, gets this through, 1, 2, you get Berlin open. And again, I don't know why it's being delayed. Obviously in Germany, they're loyal to their own manufacturers, but I'm hearing fourth quarter is when they're going to open it now. Cybertruck comes out, around the end of the year. The M2, you hear more details around the end of the year. The balance sheet continues to get better and better, so they execute in second, third quarter. I agree with you. I could see the stock getting, up to my price target. Again, when an analyst comes up with a price target, it's usually 6 to 12 months out. It's based on some discounted cash flow, but you're assuming that the market figures it out, right? It starts bidding it out, bidding up the stock and gets there. I could see us getting to 960 by the end of the year. So I just want to avoid, there might be another 10 or 15%, who knows, on the downside. I don't think it'll be 15, but another 10% on the downside. And then I think once we get through the first half and the estimates get right sized for first half, then I think you're right. You got a lot of good catalysts as you get into the second half.
Yeah. Well, Gary, thank you so much for your time. This has been a great conversation. I certainly learned a lot, and I really appreciate you taking the time to share your views with us.
All right. Thanks, Matt. See you later.
Yep. See you.
Bye.
So a huge thank you to Gary for taking the time for this conversation today, and a huge congratulations on exiting that position. Regardless of what you feel about Gary exiting or where you think the stock might go from here, it is a tremendous run that he's had and a great investment. So congratulations, Gary, and thank you again so much for your time. If you're new to the channel, my name is Matt Smith. I'm a former investment banking professional, but currently oversee a fleet of renewable energy power plants. I'm leaving that position shortly to focus on this channel, and in particular, I'll be sharing my views on Tesla energy. I believe energy will be a sustained driver for Tesla's growth in the next decade and beyond, but in my experience, this is one area that many Tesla investors don't have a good understanding of. Spark Spread will hopefully be filling that gap, while also providing commentary on Tesla from a finance and investing perspective. If this sounds interesting to you, I'd recommend watching our Tesla Energy 101 video. Please also hit like and subscribe, or consider supporting us on Patreon if you've enjoyed this content. Thanks so much for watching. I'm Matt Smith, and this is Spark Spread.